Good evening, everybody. All right, I hope you've all worn your good sweaters for tonight. All right, we've got the honor of having Dr. Barry Burns speaking to us tonight. The nice thing about listening to somebody like Dr. Burns is his trading technique is something he's developed himself with lots of educational input. So these are the type of things that you really want to get your teeth into because it's not theoretical. It's not ho-hum. It's something that's been developed so somebody can make a living at doing this. So with that, Dr. Barry, welcome to the Candlestick Forum. We're anxious to see what information you have.
Well, thank you very much. I appreciate that, and I appreciate you hosting this webinar and inviting me on. You guys are doing a great job. In fact, I'll tell you, I was looking at the website today, and I love a lot of the things that I read here, about searching for the Holy Grail. We've all been there. And, yeah, that doesn't work. And I love your mission statement, to build a community of the most educated, self-sufficient investors in the world. And I really like that because that's what I emphasize as well. People becoming educated, well-educated, as obviously you do, and also self-sufficient so that you're not dependent on anybody else. That's a very empowering thing to have the skill set so that you don't have to depend on anyone else to tell you, exactly, well, buy here or sell here. A lot of people seem to want that, but let me tell you, it's much better to do what they do here at the Candlestick Trading Forum, and that is to help you become self-sufficient investors so that you have the power. And then you know that nobody can take that away from you. So, beautiful thing. I'm totally in agreement with the philosophy, and that's why we're working together. So welcome, everybody. We've got a really great crowd here today. Gosh, fantastic. So let's jump right into it. Introduce myself here real quickly. Don't like to talk about myself too much, but I know everybody wants to know, well, who's talking to us today? So here we go. First of all, I got started in trading. I didn't really have a chance. My dad was a trader. It was his avocation and passion in life. He'd come home and talk about it every day and night and weekends. And so I really had no choice but to learn about trading. And, of course, like most kids, I wanted to be like my dad. So, I remember even at 8 years old, my dad pulling out, different research that he had done on stocks. And he'd say, Barry, which one of these should we buy? And, of course, when I was that young, I didn't have any clue, but that was the way that he started to teach me, and it was fun. It was a real bonding experience that we had together. And after I left home, I had many other teachers and mentors that I hired to work with me, and then eventually became a teacher myself. A Worldwide Trader sponsored me to do seminars around the country, so I did the seminar circuit for a number of years, but had a young family and got kind of tired of all the travel, so decided to come back home, and then FuturesTalk.net hired me to be their head moderator for their chat room. So I did the open and the close every day for years and years and years. And then got kind of tired of that. So eventually, with the wonders of the interweb as invented by Al Gore, I decided, hey, I'll just take everything that I do and, put it in videos and PDF files, put it on the internet, and people can access it that way. So that's what I do now. I got my doctorate in hypnotherapy and certified in neurolinguistic programming because I found in working with students they had a lot of trouble with the psychology of trading, so I wanted to be able to help them with that. I've been featured in a couple of books. Using Candlestick Charting is one of them. The Complete Guide to Investing in Derivatives is another one. Got about 6-7 pages in those books dedicated to me and my trading methodology. For, quite a few years now, been the first runner-up Reader's Choice Award for technical analysis websites. Oh, and also Trading Schools by Technical Analysis of Stocks and Commodities magazine. And I really am proud that I keep winning that every year because that's voted on by the students. So, That's really what matters, is are we helping our students? Are they being successful? And so, yeah, that's precious to me. There's a lot of other things. If you want to learn all my details, go to my website and go to the About Me page, and you can read all the details. But it just gives you a little idea of my background. Now, the other thing I like to do that I feel is very, very important is to please the person that's most important in all of our lives. And as we know, this probably goes without saying, but the single most important, sweet, warm, kind-hearted, gentle, loving, spiritual, unselfish, totally giving lawyers. All right, I got to mock lawyers a little bit because I've got several friends who are lawyers. But in all seriousness, this really, truly is important stuff. This is not just legalese. It's not just here to cover my butt. In fact, I'm not even selling you anything today. So put your purses away, put your wallets away. I've got nothing to sell you today. I won't even let you buy anything from me. So this is not about that. This is for you. These regulatory statements were created to protect you. And in addition to that, it's not just legalese. This is where your education really needs to begin, because these statements came out of a lot of pain, people's suffering, people's losses, and we don't want you to repeat that. That's why these regulatory statements exist. And, there's a lot of hype in the trading field. Anything that has to do with making money, there tends to be a lot of hype around the promotion of it. So I just want to spend a minute or two on this, maybe a little longer than some educators do, because I do consider this the foundation of your education to unhype the whole field and give you a realistic view of what trading is. So first of all, trading is not suitable for all people. The vast majority of people do not make money trading. So please understand that. This is not a get-rich-quick game or scheme or anything like that. No. Trading is a profession. And like any other profession, it takes education, and then you have to apply that education, so you have to get experience, and you got to get a lot of experience. You got to really apply yourself seriously to this, and it's not something that you just read, a 5-page ebook and that's free, and all of a sudden you're going to make millions of dollars. No. There's a lot of people in trading who do make a lot of money, but believe me, they're the people who have taken it very, very seriously. So you will have to as well if you want to be one of the profitable ones. So also, there's some markets that are leveraged, so be very careful about that, because it's possible to lose more money than you think you could. Talk to your broker about that. They can tell you exactly what type of margin and leverage that you have, depending on what they allow for your account and what vehicles you're trading, things like that. But you want to know what your maximum risk exposure is. Don't want to get surprised by that. In addition, because most people lose money, you only want to use funds that you can afford to lose. We call this discretionary money. So please do not trade with money that you need for your retirement or for your kids' college education or to keep a roof over your head or food on your table. No, that money is for those necessities. Money you use for trading should be extra money that you have on the side. None of us want to lose it, but if you did lose it, it wouldn't disrupt your financial stability. All information in this presentation, of course, is for educational purposes only. Just as I said, reading right off the Candlestick Trading Forum page here, my mission statement also says that my goal is not to sell courses. I don't care about selling courses. I care about creating successful traders, meaning profitable traders. That's why I do all these disclosures up front, and I do the anti-hype. Also, I want you to be self-empowered, so you have the skills. You don't need me anymore. So I never give any type of specific buy or sell advice. Of course, the information in this presentation is entirely at your own risk. It's for general purposes only. We assume no responsibility or liability for any errors or omissions, and we encourage you to seek the services of a competent, should capitalize that one, professional financial advisor before investing or trading. Alrighty, so that's what you all came for, right? But let me look over here for a second, looking at my lawyer. My lawyer, it's hard to tell. He never actually smiles, but I see maybe a little curl at the end of his lips. So I think he's satisfied. I think he's happy. Yeah, never seen him smile. Lawyers don't smile. Okay, enough of that. Let's get into it. Now, as you can see, I'm using a PowerPoint presentation here, and this is all pre-rendered, and so it's pre-written for you. So I can't customize it a lot. However, I can customize it a little bit. And, oh, by the way, let me just say this because I see some things here coming into the chat room. I'm going to wait and answer questions at the end of the presentation. So if you would hold your questions to the end because I've got a set amount of time and I want to respect everybody's schedule. So if I answer questions during the presentation, then I don't get to the end. I've already timed this out because I've given this before. And also I found that I start general, but then I get into more specifics as time goes on, and we find that about 80% of the questions are answered before we get to the end anyway. But I will be happy to stay around if allowed to answer questions, or you can email me questions at the end. So your questions are important. All right, having said that, you know what, I'm going to skip this part. Let's go to this next one, though. This one I do want to know. What are your most common trading problems, struggles, or frustrations? Because you telling me this, this will help me to customize the presentation, within reason, within the context of what I have here. So if you would, go ahead and in the chat box, just answer this question. What are your most common trading problems? Now, how will this help me customize the presentation? Okay, I can't change the presentation, obviously, but what I can do is when I come to a slide that covers a topic that a lot of you say is a problem, I'll slow down. I'll just spend more time on that topic. And if I have a slide that covers a topic that none of you mentioned as a problem, well, then I'll spend very little time on that slide, or I might not even spend any time. I might just skip that slide. So just, it allows me to determine how much time to spend on each topic, knowing what you're most interested in. Okay, wow, a lot of answers coming in. You guys are great. You're very, very, wow. Oh my gosh, I got to scroll way up here to find where, where all the answers start. Oh my gosh. Okay. Let's see. Okay, so exiting too early, picking the right stock, timing, pulling the trigger, exits, consistency, knowing when and where to exit a trade, when to get in, when to get out, exits, not making money. Well, yeah, that's a big problem, but we need to have some specific issues that we can address to get you there, of course. Discipline, psychological issue, getting it wrong time, a lot of time issues, exiting too early or too late, okay, not knowing where to put stops. Well, that's a good one, Elliot. I'm going to talk about that. Execute the trade, direction, entry, and exit. Wow, Greg, you need help with a lot of stuff. All right, you know what, we're going to talk about all that, though, so you're at the right place. Selling high, consistent profit, that's a good one. Consistency is critical. Panic selling, indecision. Letting my stop take me out. I get nervous and pull the plug early. Good one, Kent. Frustration. I make money doing credit spreads, but that means I don't make a lot of money. Directionally, it's harder to make but more money. Okay. Adding to a losing trade. Okay, good one, Alan. Getting stopped out too soon. Okay, I'm getting a lot of repeat ones, so I'm not going to read every one. I'll just look for any new ones here. Oh, here's a new one. Generally entering the Forex trade and it goes against me. Okay. So yes, that has to do with direction. Emotions. No patience. So we're getting a lot of repeats here now. And I'm just seeing a lot of repeated. Easily distracted. Okay, that's a good one. Very, very common one. confidence in my strategies. Very important, Luis. Thank you. Confidence. You have to have confidence. Risk management. Vladimir, thank you. Very few people mentioned that one, but that's a very, very important one. And Juan, another good one. Probability of trade at entry. Thank you. Another one that I don't hear very often. So good for you guys. Let's see. Okay. Trade management. All right, we got all kinds of stuff here. Okay, so now, I read out loud, and there's a lot of them that repeated. The most common ones were stuff that had to do with direction. You get in, then the market turns against you. So you bought thinking the market's going to go up, and then it doesn't. And Billy's asked like 1,000 times, do I really trade? Yes, Billy, I really trade. Are you serious? So, direction, timing is another one that people ask, both entries and exits. Choosing stocks, things like that. Let me show you, I've done this seminar before, in fact, quite a few times. Let me share with you what the most common answers from other attendees has been. See if these sound familiar. I enter the market, they say, and then they say, as soon as I enter, bam, the market turns against me and I get stopped out. And then after I get stopped out, the market goes back in my original direction. Now, a lot of you mentioned something to that effect as well. One of my mentors, he was a floor trader at the Chicago Mercantile Exchange. I got an apartment in Chicago and worked with him at the CME. And he said, one of his favorite sayings to me was, Barry, retailers are usually right, but at the wrong time. And that's exactly what he was talking about here. Right, you get the right direction, but you're at the wrong time. That's why timing is so important. We're going to help you with that today. Getting out of big moves too soon, so not making the huge profits. And that's important. Your reward to risk ratio should be favorable. And a lot of you mentioned this one. Getting stopped out too often. Again, a lot of you talked about stops. I'm going to show you in this webinar exactly where I place my stops. Okay, so we're going to cover that. Buying off support that doesn't hold the market. People who are really into support resistance levels, sometimes they just think a certain support resistance level should hold, and then it doesn't, and they don't know why. I'm going to show you why. Trading a trend that doesn't follow through. Again, quite a few of you mentioned that. So the reason I want to show you this is to actually encourage you that your problems are not unique. You're not a uniquely bad trader. There's nothing wrong with you. In fact, these are common issues that all profitable traders, including myself, have all gone through. So, therefore, don't worry about it. Just find solutions, and I'm going to share with you some of the solutions in this webinar today. And by the way, at the end of this webinar, I'm actually going to give you my timing indicator today. So as I said, for those who just came in, we had a lot of people, wow, a lot of people have just come in here late. So for those of you who just came in, let me tell you, not selling anything today. I don't have anything to sell at all. I'll give you a gift at the end that's absolutely free. And one of the gifts, actually a couple gifts, one of them is going to be my cycle indicator. And share that with you and how to trade it. Okay, so you're going to get that today before we're done. Before I can get into the timing aspect of it, though, I need to give you an overview of my entire methodology. Why? Because trading is not about any one thing. All right, so just like Stephen said, there's no holy grail. That's right, there's no one thing. That's a holy grail. Successful trading comes from putting together a number of variables, a number of factors that when they are put together, give you a probability scenario that favors you. So that's why I call mine a trading methodology. It's very methodical. It's objective. It's rule-based. It's orderly. And my method is all about one thing, measuring what I call the energies in the market. Okay, so let's just start out and build our structure first, our outline, so you know what I'm talking about, and then we'll get into more detail. So first, let's just list these 5 energies so you know what I'm talking about when I refer to this term energies. So energy number 1 is trend. That simply refers to direction. And by the way, when I look at a chart to potentially take a trade, I always look for these energies in this order. As I said, My trading is very methodical. So always this order. Number 2, momentum is the second energy. That tells us what the strength of the trend is, because we only want to trade strong trends. Number 3 is cycles. Now, this is where the timing part comes in. So now you can see why I've got to share with you the overview of my entire methodology, because the timing part doesn't even come in until number 3. If I don't have number 1 and 2, I don't even get to 3. It has to be part of the whole package. You don't use it alone. You can't use it alone effectively. The 4th energy is support resistance, which is really a blockage of the first 3 energies. And then the 5th energy is what I call the fractal energy. And fractal just means looking at the same thing on a different scale. And in trading, that means looking at multiple time frames. Okay, very common practice among traders. I do it differently than most. And when we get into the details of that, I'll show you how I do it differently and why I do it differently. Anytime I do something that is against the orthodox approach to trading, and I do quite a few things that are against the orthodox approach, I always explain the logic behind it so that you can determine whether it makes sense to you or not. Okay, now, since we're doing a methodology, we need some objective instruments for measuring those energies. In other words, Energy 1 trend. I don't want to just look at a chart and say, well, it looks like it's up. That would be discretionary. That would be subjective. So no, I use objective instruments that will tell me what that energy is, and everybody will read it the same way. So just in general, and again, I'll get more specific as we go on, for trends, I use a moving average. For momentum, of course, I use a momentum indicator. For cycles, I use the oscillator that I'll be giving you. For support resistance, I use primarily 4 things: previous cycle highs and lows, previous wave highs and lows, 4 trader pivots, and Fibonacci levels. And then for the fractal energy, I use a longer term chart. So if I'm trading a daily chart, I'll look at a weekly chart, and that weekly chart is my fractal energy. If I'm doing intraday, then I use a 3-to-1 ratio. So if my setup chart is a 5-minute chart, then I would look at a 15-minute chart. The 15-minute chart then would be my fractal energy. So why are we doing this? Why am I even looking at these 5 energies? The whole thing is to determine a probability scenario. In trading, there's no certainties. I get people asking me all the time, well, how do you know if, or how do you know when, how do you know whether? As soon as somebody starts the sentence that way, I have to just put the brakes on and say, you don't know. Just using the word know, K-N-O-W. You don't know anything. Nobody knows the future. It's amazing to me. Most people, they think, what, you can't predict the future. They don't believe in, people being able to forecast the future. But when it comes to trading, somehow they think we're supposed to be able to do that. And some people do believe you can do that. But the professional traders that I know, they all say we're simply working with probabilities. And that's exactly what I am doing as well. So, famous saying in trading, the market can do anything at any time. And believe me, after watching the market for close to 40 years now, I've seen a lot. And you've seen it too, fat finger trades, news that comes across the news wire that's unexpected, like God forbid, terrorist attack or war breaking out or economic collapse, whatever. These things happen, and the market doesn't care what your Fibonacci levels are, what your RSI says, what your CCI says. No, none of that matters. And then, boom, everything goes crazy. That's just an extreme example to demonstrate how the market can do anything at any time, and you couldn't have predicted that in advance. Okay, so basic question, though. How do we determine a probability scenario? How do we make trading different than gambling so that the odds are on our side? Well, the way I do it is actually quite simple. At each entry point, or potential entry point, I ask myself one simple question. How many of those 5 energies are aligned, all saying buy or all saying sell at the same time? I then give each setup a score of 1 to 5, based on how many of the energies are aligned. Obviously, the higher the score, the higher I consider the probability of success. I liken this to taking the trade to court, and I need 5 independent witnesses to establish a preponderance of the evidence. Now, the operative word here actually is independent. So, if I were to use a chart and have 3 trend indicators on there, for example, that would not be powerful when they all agree because they're all measuring the same thing. They're redundant. The power of using these 5 energies is that they are all uncorrelated to each other. Each one is uncorrelated to the other 4. And that's what's powerful. They're independent. So, let's just take a quick little example here just to make it clear. So let's say that price is trending up. All right, price is trending up. Then I go to energy number 2. Sometimes when price is trending up, momentum will also be going up. They're aligned. They're both going up. Other times when price trend is going up, momentum is flatlining, just flat. And yet other times when price trend is going up, momentum is actually going down. Complete opposite direction. That's because those 2 energies are independent of each other. They're not correlated. And that's true of all 5 of them. So that's the important thing, because that's what makes it significant when they all say the same thing. That's what puts the odds on our side. Okay, so now let's go to the next level of depth, get into a little more detail as I promised, and let's look at those 5 energies again, but this time let's show some charts and, as I said, get a little more specific. So energy number 1 is trend. And for my trend indicator. And it's the red line on the chart there. Now, many people say that the trend, actually, in fact, I won't even say many people. The orthodox definition, the classic definition of trend, is for an uptrend, higher highs and higher lows, or conversely, lower highs and lower lows. But there's a problem with that, and I don't follow that definition personally for 2 reasons. Number 1, etymologically, it's not really right. So, when we want to know what a word means, we go to a little thing called the dictionary, of course. And Webster's dictionary defines trend this way: to extend in a general direction. All right, think about that. To extend in a general direction. A little ridiculous over-enunciation there. But I do that to make the point that the term trend refers to a long-term move. That's the etymology of the word. That's what the word really means. So, for example, let's look down here. Here is a higher low. And here is a higher high. So, by orthodox definition of technical analysis, that would be considered an uptrend. However, that is not a long-term move. That is not the extended general direction of the market. The extended general direction of the market is down. That's the long-term direction. And the red line, the 50-period simple moving average, indicates that by angling down. Now, some people at this point ask me, well, why don't you use a shorter-term moving average like 9-period or 20-period? Because that follows price more closely. And it does follow price more closely, and that's exactly why I don't use it. I want a long-term moving average to measure the long-term direction of the market. And besides, I don't need an indicator that just follows price. I can see what price is doing. In fact, the most important thing of indicators is when they show you something totally the opposite of price, such as here. Higher high, higher low. The market is moving up here short term, but I just consider that a short little complex retrace up in an overall downtrend. Therefore, amateurs will buy this. The amateurs will buy this first higher low. And that's great. And I will fade their trade. That's what pros do, is they fade the trades of the amateurs. And why do I do that? How do I know to do that? Because the trend indicator is showing me that I'm supposed to be shorting. That's where the big reward is going to be. See, the amateur's reward is from there to there. Professional's reward is from there to there. Better risk-reward ratio. Huge difference, huge. So not only is this definition of trend using the 50 MA more etymologically correct, it's also better from a business perspective. It's more profitable. Okay, energy number 2, momentum. Now, let's look at this chart. We have a higher high, higher low. Higher high, higher low. 50 MA is angling up. If we were trading at this snapshot in time right here, at the hard red edge of the screen, which is, of course, where we do have to trade, we would look at that and say the trend is up, and we would actually be right. The trend is up there at that snapshot in time. However, would that be a good place to buy? Well, of course, we can see the rest of the chart, and we know the answer to that already. But how would we have a knowledge of the probability of whether that would be a good buy or not when we can't see further into the future? Trend does not help you with that. Trend does not help you. Trend is actually a lagging indicator. So we need something else, and in this case it's momentum. Let me take the curtain off my momentum indicator down here and show you. So, question is, how would we know to buy this higher low and not that higher low? You look at momentum. Here, momentum is well above the 0 line. Okay, holds above the 0 line on the retrace. We put in a much higher high on price, but an equal high on the momentum indicator. That's your first clue that this trend is weakening. Momentum is about strength or weakness. So that's what we're looking at. Yeah, we've got a much higher high. Yeah, trend is still up, direction's still up, but it's getting weak. Then, when we get a higher low on price, momentum gives us an actual lower low and goes down to 0, meaning there's no more strength in this uptrend. So, do we like to buy trends? Yeah, some, but not all. We like to buy strong trends, but not weak trends. And momentum is what helps us to determine whether the trend is strong or weak. We buy this, not this. The amateurs will buy it. I mean, some did. There's 2 green bars after that. And then we put in a much lower high. So we could either short there, or even there, and fade the trade. So in this way, as you can see, again, as I said, look for where indicators actually do the opposite of price. They do something different. That's where your significance lies. That's where your edge lies as a trader. That is important. In fact, you can see here that momentum is actually leading price. It turns down before price turns down. And so it's a potentially leading indicator. Very, very powerful. Okay, energy 3 is cycles. And I'll give you the cycle indicator here in just a few minutes. Cycles is about the timing. It's interesting to me that so many traders, I look at their charts, and they got all kinds of indicators on there, usually too many. It's a mess, chaotic, and confusing, and the confused mind cannot act. When I was in Chicago, most of the people there, their charts, the professionals, their charts were actually very simple, very clean. They didn't use a lot of stuff on their charts. So that was one of the big differences I noticed between amateurs and professionals. Amateurs' charts were cluttered, professionals' charts were pretty darn clean and neat and orderly. So one of the things, though, that's interesting is even though the retailers or the amateurs had a lot of stuff on their timing indicator, and that is foolhardy because, well, think of it. A chart is a two-dimensional object. We have price on the right, and we have time on the bottom. So there's only 2 dimensions here. So if you don't have any kind of timing indicator or timing tool, then you're leaving off 50% of the information on the chart. And since trading is all about establishing probability scenarios, well, how can you have a probability scenario when you're blind to 50% of the information? Not good. And even those 50% of the information, W.D. Gann said that of the 2, timing is more important than price. So when we talk about timing, we're looking at, I like to buy low, sell high, right? Buy retail, or buy wholesale, sell retail. So the markets go up and down, but they don't go straight up and down. They're not that neat and nice and orderly. They kind of wiggle up and they wiggle down. And so that's what we're looking to do, is to catch the lows and the highs. Not necessarily, the final low or the final high of big moves, but the smaller cycles within those moves. Energy 4 is support resistance. Now, here's some Fibonacci levels. This is one of the things I use for support resistance. Just a cursory glance at this chart, and you can see that sometimes price goes through those levels, and other times it bounces off. So now the question becomes, well, how do I know, or how do I establish a high probability of which of these levels the market will bounce off of, putting in a higher low, and which of those levels the market will just slice right through? Again, just using Fibonacci or just using any one support resistance type tool, you don't know. You don't. See, there's a lot of people out there who say indicators are no good. And they say, oh, I just trade price patterns. And you know what? As you can see, I do use indicators. But on the other hand, I agree with them about 75%. Yeah, they're pretty right. They're more right than wrong. So why do I use indicators? Because, if you remember with my methodology, I am not depending on any one indicator. Any one of these indicators used by itself, garbage when it comes to making money. I mean, they're pretty amazing, actually. The people who created these are very creative people and pretty ingenious. But as far as making money, I would not rely on any one of these indicators at all, because they're just not that helpful. So that's why in my method, I need the preponderance of the evidence. I don't rely on one. Number one does not give you a probability scenario. I need 5 independent witnesses to establish a preponderance of the evidence. So in this case, well, let's just take a look at it. We'll look at this last arrow here. So price comes up, and it comes up into this resistance level, this blue line. What is that? Okay, it's 2 things. Number 1, it's this wave high. And number 2, it's our 50 Fibonacci level. So how do we decide that we think it would bounce off of that? Well, we see it's there, but we have to look at our other energies. Are they aligning at that same time, at that price level? If they're aligning at that price level, then we say, okay, that has a good chance of holding. So first of all, it's a cluster, because there's 2 levels there, actually. So it's like a double thick ceiling. Next, it is an engulfing candlestick pattern high, so that adds to the probability. Next, the 50 MA is angling down, so the direction to trade is down. Then, in addition to that, our cycle indicator comes up here, turns red, and goes down, indicating it's time for the market to put in a high and go down. And then finally, we go down and look at our momentum indicator down here. And notice when price goes down, momentum goes way below the zero line, way below the zero line. So strength occurs when the market goes down. When the market goes up, momentum barely gets above the zero line. There's no strength there. So it's much more likely that resistance will hold overhead. So again, everything's really aligned, saying down, down, down. And finally, the 5th energy is what I call the fractal energy, just a fancy name for multiple time frames. I promised I would show you how I do this differently than most people. So yeah, let me do that now. All right, so here on the left, we have a 100-tick chart. And when I'm day trading, I use a multiple of 3 for my higher time frame, or my fractal chart. So I'm using a 300-tick chart over here in this case. So my setup chart is here. So let's look at the setup. What do we got? Well, price is above the 50 MA, a directional indicator. So now we're looking for shorts. Also provides resistance. Also engulfing candlestick pattern high. Also cycle high. Also momentum below 0. See, everything is aligned, saying go short, go short, go short. Now, what do we need over here on the fractal energy? The traditional way that I see most people use multiple time frames is they say, I will only take trades in the direction of the trend of the longer term chart. Now, here's why that doesn't make sense to me. Number 1, The long-term chart is a slower chart. In this case, 3 times slower. We're only going to get 1 bar here for every 3 bars over here. So it's 3 times slower. And then we've already shown how trend is a lagging indicator. So why would I want to confirm my setup chart with a lagging indicator on a slower chart? I mean, the timing is just way off, way off. So I want to tighten up that timing a bit to confirm the trade. So instead of using the lagging indicator, I use the potentially leading indicator, which is momentum. So since I'm going short here, or looking to go short, I won't go short unless momentum is also going down on the longer term chart. And I also like that cycle going down. What trend is doing on the long-term chart, frankly, I don't give a mouse's left patootie. Don't even look at it. Don't care. It's just too slow in relation to the setup chart. Okay, so last slide here before we get into the timing indicator, and just put it all together and walk you through a trade and how the 5 energy method works. So we've been going down here. This is our setup chart on the left. We've been in the downtrend for quite a while. I have a general rule that says the longer the trend continues, the less likely it is to continue. So when I trade early in a new trend, and again, since my trading is very objective, the word early has a clear definition. And that definition is early means the first 2 retraces in the trend. That's it. After that, I'm done. I'm not going to trade in the direction of the trend anymore. I do have rules where I'll trade against the direction of the trend after that, but not with the direction of the trend. Okay, so let's just walk through the 5 energy method. It's actually pretty simple. So now, boom, we come above the 50 MA, all right? And now back we have our little retrace, so we can buy it wholesale. 50 MA starts angling up, so now that's our first retrace in a new trend. So is trend on our side? Yes. We can score our trade here. We'll count to 5. So energy number 1, we got it. Second thing we look at, always look at it in this order, momentum. Is it a strong trend or a weak trend? Well, the price retraces, which is great. Momentum holds well above the 0 line, so therefore we consider it a strong trend. We've got a score of 2. We can keep going. 3, what about timing? Yep, cycle indicator hooks back up, so we've got the cycle low. 4, we have to bounce off some sort of support since we're buying a retrace. The red line's the 50 Fibonacci level. Yes, so far we have a score of 4. Now, we always must have the confirmation on the next higher time frame. Will not trade without it. It's actually a filter. It will filter me out of otherwise good setups. So we look at the chart on the right. That's our confirmation chart, or our fractal energy. And what do we see over here? Well, the 50 MA is angling down, but we want to go long. So, does that keep me out of the trade? No, because that is a lagging indicator in a slower chart. So I look at my momentum indicator. Remember how I said trend can be going down and momentum can be going up because they're independent energies? Well, there's an example right there. So the momentum is going up very steeply, very nicely, and so is cycle. So it confirms the trade, and boom, we've got a 5 out of 5 score on that trade, and we can take it. And that's it. Okay, now let's get to this cycle indicator. Here we need 3 things: the right indicator, the right inputs, and the right technique. I encourage you to get a pen or pencil out and a piece of paper because we're going to get super specific here. We're going to go through all 3 of these. Order chaos cycles. I'm going to skip this one right now so that I have a little time for questions at the end. All right. So here we go. I just want to get right into it. All right. So here's the indicator I use and the settings. Now, the indicator is just the good old-fashioned stochastic indicator. I don't use any of the fancy ones. They might be good for other purposes, but for our purposes, I just want to use the traditional stochastic indicator. In fact, I don't use any fancy indicators at all. I use just standard stuff. Now, if you have a choice between fast or slow, choose the slow one. The interesting thing here is that it's kind of ironic I'm using stochastic for a cycle indicator because the stochastic indicator is not a cycle indicator. It's a momentum indicator. I've actually used and bought and paid good money, thousands of dollars, for some really fancy, schmancy cycle indicators, and I've found this works better. This works better. Okay, but you have to make some changes to it. And actually, before I move on, the reason this one works better is precisely because it has that momentum aspect to the formula. That's the magical part here. It's kind of ironic. You'll see what I mean here in a moment when I show you how we trade it. But before we get to that, we've got to make some changes to it. We've got to turn it into a cycle indicator. So what we do is we just change the inputs, all right, or the parameters. So period D, or sometimes it's called percent D, we want to change that to a value of 3. Period K, or percent K, we want to change to a value of 5. Smoothing, or sometimes that's called average in some software charting programs, we want to change that to a value of 2. And then your upper and lower horizontal lines, you want to change those to a value of 20 and 80. 20 and 80. Also make sure that it calculates intra-bar. It doesn't. You don't want it to wait and calculate at the close of the bar. Okay, so those are the changes we make to turn it into a cycle indicator. Now, little review because this is important. Sometimes people get a little too darn excited about indicators, and I already told you what I thought about indicators. You know, any one indicator is useless, including this one. But here's what I mean by that. By itself, it's meaningless, like any one energy. Therefore, when it comes to cycles, you must only use this indicator strategically with the other energies. Meaning, we don't trade every cycle high and low. We only trade the cycles in the direction of the trend early in the trend, the first two retraces. We only trade cycles that have momentum behind them. We only trade cycles that have the fractal energy aligned. And, this one's new, we only trade what I call second chance indicator patterns. Okay, what in the world are these second chance indicator patterns? Second chance indicator patterns, they indicate a momentum shift. Yes, I see the typo. It should say shift, not shirt. At the top or the bottom of the cycle. Now, this is where the stochastic indicator becomes so powerful in identifying the final cycle low or the final cycle high for you to buy or to short so you don't get stopped out so often. Because it has that momentum aspect to it. And you can see in the pattern that I'll show you here in a minute that momentum shift at the top or the bottom. And we're going to wait for that before we take a trade. So I'm going to show you right now one of these second chance patterns called the mini divergence. That's just one second chance pattern. There's 5 others for a total of 6. And again, the point of these second chance patterns is that they provide extremely high probability, and I mean really high, that you found the final cycle low to buy or the final cycle high to short so you avoid getting stopped out so often. So the best way to show this is actually visually. So here's a chart of Verizon. Down here in the bottom, there's our stochastics, 5-minute chart. There's our new parameters, 3, 5, 2. Okay, here's our stochastic indicator. The black line is percent K. The blue line is percent D in this case. Notice, I want to show you a few things. You really need to understand how your indicators work. And not just trade patterns. You have to understand the nature of them and why they do certain things. So traditional buy signals are usually when, there's 2 primary ones, when K crosses back up above D, or when the stochastic gets below the lower horizontal line here and then goes above it. Well, if you did the traditional buy signal here, you'd lose. Second loser, third loser, 4, okay, 4 you make some money, now it finally goes up. Why does that happen? Why are these lousy signals when price keeps going down, 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 down? Stochastic does not continue to go down. That's because stochastic, if you look at the formula, the math of it, it's what we call a bounded indicator. It's not allowed to go below a value of 0, and it's not allowed to go above a value of 100. So, when price keeps going down, 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 and the indicator gets down to 0, it can't go down any further, so it just bounces around the bottom here. So that's why these signals are meaningless. Same thing here. Gets up to 100. We get a cross down. Price makes a higher high. Again, another signal to go short here. Goes down a little bit, and then it takes out that high. So people are getting stopped out over and over and over. Now, here we finally find the final cycle high. Now, if you're just looking at price, how would you know that that is the final high? Maybe this was the final high, or this one. Well, it's covered a little bit by the old Post-it note there. But they all look pretty much the same. So this is where your indicator comes in. Again, when your indicator does the opposite of price, pay attention. Something to be aware of there. So in this case, mini divergence. Higher high in price, lower high in percent K. So, remember, stochastic is a momentum formula. Even though we turned it into a bit of a cycle indicator, it still has that momentum calculation in it, and momentum can lead price. And that's what it's doing here. It's making a lower high before price does, showing us that even though the market's still moving up, it's moving up on weakness now. And that's the signal we look for. We're not going to take the short until there. Now, I call this a mini divergence. A lot of people teach divergences, and normally what they're talking about is between this high and this high over here, with the indicator going down to the bottom of the trough in between. Personally, I have not found those to be consistently profitable, so I don't trade those. I call this a mini divergence because the two highs are very close together, and the indicator, the whole indicator is at the top of the range. It never goes down to the bottom, so it's still at the top of the range here. That's your actual cycle high, right there. And this is just a scalp trade, okay? This is a reversion to the mean trade because we've already been going down, down, down. We've had a long trend down, so I'm not going to trade the trend anymore. We talked about that. So this quick little scalp trade, reversion to the mean. Now, same chart. Let's look for the long. Again, here would be a traditional long signal. KD cross goes above the lower horizontal line. Some people bought it. This bar makes a higher high than that bar. And then they get stopped out. We break the low of that. So we know those are no good. We're going to trade that. We're going to wait for the mini divergence. Lower lows on price. A little higher low on percent K. See, it's just a little mini one. And those are the ones we want. Those are the only ones I'll trade. And so that's, again, a momentum shift showing that there's weakness going down, and now we expect strength going up. So we get a higher low before we get it up. We get it on the indicator before we get it on price. Okay, let's get super specific. Answer some of the questions you guys asked later, some of the problems you were having. So where exactly would we enter? Okay, we would enter 1 penny above the high of this inside bar here. I would just put a buy stop in there. So as soon as that mini divergence is confirmed and K is angling up, the very next bar, I just put a buy stop above it. Now, stops. Lots of you said you had problems with stops. The stop goes, well, here's my general rule. I always have general rules for things, and then we create an application for it. So the rule for stops is stops go where you're wrong. That's the rule. Stops go where you're wrong. I don't use percentages or, any volatility or any of that kind of stuff. Average true range, those kind of stops. Some people do. It's fine. That's great. I'm not comfortable with that. I'm so confident in this indicator nailing highs and lows that I can place my stops with great precision. So when I say that stops go where you're wrong, what I mean is you look at the reason for taking the trade. The reason for taking this trade is now I'm above the 50 MA. I've stayed above the 50 MA here. First retrace in a new trend going up, so now I'm in a trend trade, and I'm buying a cycle low. The cycle low is right there. So if the market, before it makes a cycle high, if it were to turn around and take out this low, then, well, I didn't buy the cycle low. I would be wrong, and therefore I want to be out immediately because my trade would no longer have any basis The reason I got in doesn't exist anymore. So therefore, my entry is there, and my stop is 1 penny below the low of that bar. So that's my risk. And I put a hard stop in, meaning I put it right into the execution platform, and I just let it sit there. And I do not move it. Well, I'll move it later once I get into profit and use a trailing stop. Okay, now what's our reward on this trade? Well, we won't know exactly what it's going to be, but here's the idea. Since we're doing a trend trade now and not a reversion to the mean scalp trade, the average trend I consider to last 5 waves. That's wave 1, 2 would be a higher low, 3 would be a higher high, 4 would be a higher low, 5 would be another higher high. So something like this is our reward, and that's our risk. And that's why we trade trends, as we talked about. So let's finish up here, and maybe I'll have a few minutes for questions still. The summary is just, this is very simple. I wait for the alignment of the 5 energies to put the odds on your side. And, I went to a trading club. I was invited to speak to a trading club across the country. Big trading club. I won't mention who they are, but they're one of the biggest. So I went there and I talked to them. And the leader of the trading club, he took me out to dinner. He was a very nice guy, and it was a great experience. But they were working on a trading methodology that they were going to computerize. They weren't done with it yet, but he brought that out and showed it to me, and so far it was up to about 250 pages. 250 pages of rules. And I smiled and said, wow, that's a very ambitious project, and he was very proud of it. Okay, here's my trading rules. One sentence. We're looking for a trend, up or down. If there is no trend, we usually don't trade. Okay, so trend number 1. Am I looking to buy or sell? That's the very first thing I'm interested in. Then we look to energy number 2. Is it a strong trend or a weak trend? If it's strong, we're still interested. If it's not strong, I'm either not interested or I will fade it. Then I have to ask, okay, when do I want to get in to that trend? That's energy number 3, cycles, using our mini divergence pattern or one of the other 5-second chance patterns. Then, number 4, make sure I'm bouncing off support, since I'm buying and selling retraces. And then number 5, before I can take the trade, I just need to make sure that it's confirmed by the higher time frame. And for that, I'm looking to trade in the direction of momentum on the higher time frame, not trend. The method's very robust, adaptable. I use the same 5 energy method for trading stocks, commodities, options, currencies, and futures. And yes, I do trade all 5 of those. I also use the same 5 energy method for investing, swing trading, and day trading. And sometimes people ask me, well, how can you use the same method for all these markets and all these time frames? And the answer is pretty simple. It's because I'm just using objective instruments to measure the energies. It's like a compass. I have a compass and I measure the direction of a turtle crawling. Great, it tells me the turtle is crawling east. Then I pick up the turtle and I put a cheetah down. Well, totally different type of animal, right? But I don't need a different instrument. I still use a compass, even though that's 70 miles an hour. I think they run like that fast. And I just still use the compass. So it's the same thing here. The instruments being on your chart, they will just measure whatever market or whatever time frame you put on that chart. So it's very simple. Objective, and we're pretty much just counting to 5. So here's my other gift to you, other than the indicator I just gave you, is my free 5-day video correspondence course. And what this simply is 5 interactive videos. Really what this is about is the difference between how professionals trade and how amateurs trade, based on my experience of working with both. That's what this 5-day video course is really all about. So it's absolutely free. You're welcome to just take it and run. At the end of each video, it's actually interactive. So at the end, there's a quiz, and it's multiple choice, and you get your answers right away on your computer screen. The 4th video has my favorite trade setup, and you get that for free too, the rubber band trade. I love this trade. It's a little scalp trade, but the win-loss ratio on it is huge. So take that with my compliments. And you can get it there. You can see the URL, topdogtrading.com /free.html. So, wow, according to my clock, it is right at the top of the hour. Okay, I don't know. Do I have time for questions, or do we have to cut it off right now? You tell me. I will put my email address in here. And, you guys can definitely send me an email if you have any questions. It's Barry at top.
Dr. Barry or Dr. Burns, go ahead and take questions. Everybody's here.
Great, thank you. Okay. So yeah, my email is Barry at topdogtrading.com. So if you don't want to ask a question publicly, that's fine. You can send the question there. Or if I don't get to you today, there it is. I just typed it into the general chat room, by the way, Barry at topdogtrading.com, so it's there for you. Okay. Wow. Oh my gosh. Here they come. You guys are great. I got to tell you, of course, we got a huge group here. But, okay, I'm not going to be able to get to all these questions. I'll be here all night. But I really appreciate your guys' enthusiasm. So let me just take a few here. Oh, great. Thank you. Yeah. So they're doing a recording of this, and they will email it to you tomorrow. So that's great. Golly, I don't even know where to start. There's so many questions here. Whew. Okay. I'm just going to have to pick some at random here. This whole chat room is scrolling by me so fast it's hard to even keep track or even read one right now. Okay, what platform or charts do I use? Okay, I saw that one. I was able to read that. I like NinjaTrader. I love NinjaTrader, so that's the primary one that I use. I use Mirrors Futures for a broker. So that's, I have several that I use, but those are my primary ones. Do I trade options? I absolutely do. Yeah. I started out being a stock trader because that's what my dad was. And then one of my mentors got me into trading currencies, and that was before Forex became real popular. So I did that, and that was great, and I still do that. Well, no, actually, I went from stocks to futures and then to Forex and then to options. Yeah. And I do all of them now. This question came up a couple times here, I noticed. Any software to find all energies aligned? Yeah. I have created some scanning formulas for a program called StockFetcher, which, by the way, I have no business relationship with them whatsoever. And also, we've got some scanning abilities with NinjaTrader, Market Analyzer, TradeStation, and TC2000. So it won't give you, I do want to warn you, it's not going to just, plop the trade down in your pocket and say, here, trade this. But it does, you can see when the energies are starting to align. Then you look at the chart and make your decision. So, yeah. They're going by fast again. Okay, psychology, yeah, a lot of you are asking psychology type questions, it's really important. I don't want to dismiss that. It's just such a big topic. I don't feel that I can do it justice in this short time. So, if you're interested, I do a free webinar on the psychology of trading. And so if you want to sign up on my mailing list, the next time I have that webinar, I'll send you a note. And we spend an hour on it, so. But, yeah. No, I do not offer trade signals at all. My goal is to empower you to become a trader and get the skills and be self-empowered so you don't have to depend on anyone else, including me. My biggest compliment is when you don't need me anymore. Momentum indicator, yeah, a lot of people have asked that. Thank you, Glenn. Again, that is another big question, so it would just take too long because not only would I have to tell you, first of all, I will tell you, I don't use what's called the momentum indicator. Just like with cycles, I don't use a cycle indicator. So it's the same kind of thing. I use a different indicator. It's a very common indicator, though. I changed the inputs, so I'd have to tell you the inputs. But even that wouldn't help because then they'd have to show you the patterns that I trade, just like I did with stochastics. So again, it's just too involved to address in a couple minutes here right now. Well, we got some long questions here. Okay. Sorry, I guess a lot of the questions are actually similar. People asking about scanning, people asking about the momentum indicator. Yeah, Michael, you're right. Yeah, leading indicators can give false entries, absolutely. But that just goes back to what I was saying before, why I don't rely on any one indicator. Any one indicator will lose you money faster than you can say, I'm going bankrupt. So, yeah, we don't. All indicators have problems. None of them are perfect at all, not even close. So that's why we don't give any validity to any one of them at all. It's about the confluence of energies, five independent energies establishing the preponderance of the evidence. Yep. Okay. Bill says he likes to have at least 2 triggers before taking the trade, but 5 may cause analysis paralysis. Okay, well, that brings up an interesting point that is a great issue to address. And, yeah, see, now for me, my methodology is based on having enough variables that when they align, you create a probability scenario. 2, to me, is not enough. 2, to me, is not enough at all. 5 is good, and I understand what you're saying about, the more information you have to consider, it can create mental confusion and overwhelm, and you are 100% right. So the issue is we've got to find a middle ground there. And actually, one of my favorite quotes from Einstein is, who never traded, I don't think, but he wasn't talking about trading, but it applies to trading. He said, you want to make everything as simple as possible, but no simpler. And I think that really does apply to trading. So, simplicity, yes, but not too simple, because if it's too simple, you don't have enough variables to create a probability scenario. Now, with regard to the 5 energies being, too many to cause analysis paralysis, what you find is where these 5 energies, you don't really have to think about them very much. I mean, after you start, it's like anything in trading. 5 is a good number because I can just look at a chart. I mean, when I walked through it with you guys today, yeah, I sat there and I counted 1, 2, 3, 4, 5, because it's the first time you've seen it. But for me, and for my students, we just can glance at a chart, and we can tell you in like 1 second how many energies are aligned. So it's not information overload at all. You get to the point where you just recognize the pattern. There it is. Yep, it's obvious. I mean, literally in a second or two, you can just tell. So, yeah, it's because it's visual and very, 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 very simple and easy. But your point is very well taken. Very well taken. Okay, gosh, a lot of psychology stuff, option stuff. Yes, I do look at the indicators are the same on both charts. When it's a 3-to-1 ratio, the indicator inputs are the same on both charts. Okay, why do I use the SMA if EMA puts more importance to current activity, which is more important than past activity? Also, why the 50 SMA? Okay, Art, that's a good question. I get that a lot, so I'll answer that one because that's of interest to a lot of people I know from experience. Okay, so basically, as I said in the webinar, we want an indicator that measures trend, and trend is defined by the dictionary as the extended general direction of the market, meaning long-term move, extended general direction. So we want to use a longer-term moving average to measure the longer-term move. So 50 is a longer-term number. Now, why 50 specifically instead of 49 or 51 or, any of the other numbers out there? Okay, so where that comes from is very simple. On daily, weekly, and monthly charts, the 50-period moving average and by the way, it's the 50 simple moving average and the 200 simple moving average are the most commonly used moving averages. So even people who really are not into technical analysis, a lot of them will look and have those two moving averages on their charts for daily charts, weekly, and monthly charts. Now, why is that important? Is there any magic to those numbers? Absolutely not. However, when you have a lot of people looking at the same thing, then they're responding to the same thing, and therefore it becomes important. It becomes kind of a self-fulfilling prophecy, if you will. So that's the reason that I use the 50 SMA. It comes from that. Then I just use it on every chart interval I have because it does measure the long-term move, and I want all my charts to look the same so that my eyes and my brain gets used to seeing the same patterns all the time. I don't have to change it for each chart. My brain is programmed to see that because I'm always looking at the same indicators, the same inputs, and all of that. Okay, so on intraday charts, it's not quite as prominent, but hey, it does what we want it to do. Exponential, you're right, it does put more weight on the more current data. Wouldn't say necessarily that the more current data is more important. And the other issue is that, for example, as I said, the standard indicator used on daily, weekly, monthly is the 50 simple. And the 50 exponential, it would follow price more closely. And I don't want it to follow price more closely. I want it to lag. And the reasons, again, I pretty much showed you that. I want it to show me things different than price. The more the indicator looks like price, the less useful it is. Then I just look at price. So I want it to show me things different than price pattern. That's when I pay attention. And, for example, the rubber band trade, that's on my 5-day free video correspondence course here that you're getting. On day 4, that relies on the 50 simple moving average. It wouldn't work very well on the 50 exponential, but it works amazingly well on the 50 simple moving average, precisely because it's slower. So, yeah. And I can understand people struggle with this. I get it. I did too. My first major trading course that I took, where, I went away for like 2 weeks and did intense study. Man, that guy had us actually get out pieces of paper, and we hand drew our frickin' charts. Literally, we had to hand draw every bar. So that's how hardcore that was, and old school that was. And he talked about lagging indicators and how great they are. And I thought the guy was nuts. And we all thought he was nuts. We thought, what? Why would you even want a lagging indicator? I want leading indicators because they're better. They tell us the future, right? Well, they each have advantages and disadvantages. A lagging indicator tends to be more reliable because it requires more data before it gives you the indication. But because of that, it's late. Potentially leading indicators, you notice I always put that word potential because they're not always leading. Nothing always leads the market perfectly. Potentially leading indicators, they can show you what might happen before it happens, but they tend to be less accurate. And that's why we don't rely on either one of them exclusively. We learn how to watch for the alignment of the energies. And then we've got something really significant and powerful. Okay, I'm going to cut it off here pretty soon, but let me just see if there's another question here that a lot of people are asking. I'm trying to find ones that a lot of people are asking. I do not offer live trading sessions anymore. I used to have a trading room, but Frankly, it just, got to be a little tiring. Yeah, gold is a good market to trade. I like trading gold. When watching cycles, do you wait for the bar to be closed or trade when you see it hooking up? Okay, Terry, that's a good question. It has to hook up and close hooking up. Then my entry is one, penny, tick, pip, lot, whatever, not lot, penny, tick, pip, above the high of the bar that created the hookup on K, that's closed. Okay, that's good. Happy to clarify that. Have I changed my trading style in the last 10 years? No, I haven't changed the style. I've refined it a little bit. But, once I got onto this 5 energy methodology, I've never looked back. You've been doing it wrong all these years? Well, hey, if you're making money consistently, you're doing okay. There's more than one way to groom a cat. So I'm not saying this is the only way. In fact, I've got old friends out there who trade very differently than me, and they make money. So God bless them and the horse they rode in on. But, yeah. So I'd never say that this is the only way. Well, thank you. Appreciate a lot of compliments are coming in here. I appreciate that. Just again, scanning through here to see if there's any question that a lot of people are asking so that I can make sure that you guys are all getting... Oh, okay. Volume, yes, that's another issue. Volume, first of all, volume is not an indicator. Volume is a statistic, okay? So indicators indicate. They don't tell. Volume tells. Price tells. Do I use volume? Yes. However, these 5 energies that I've shared with you, these are the 5 energies that I look for in every single trade. They are all significant on every single trade. Volume, yes, I do use that, but I don't find it significant on every single trade. So I'll use it, I'll look for volume patterns, and when they're there, I take them into consideration. So yes, that's again another one a lot of people ask. Okay. Yeah, I do day trading. I do swing trading and investing. I do all of those things. Oh, yeah, one of my students does have a chat room, or has a trading room. So you could tap into that. And he has quite a few people in there, actually. All right, yeah, the session has been recorded. Yes, I do definitely include everything in my courses, which, again, I'm not even telling you how to get my courses because I want you to get the free education here first and see, you get a feel for my education, see if it's right for you. But in my courses, I give everything. I give risk management, money management techniques, so all that stuff that you need. It's not just technical analysis, because technical analysis alone is not a complete methodology. Complete methodology includes money management, risk management, all that stuff. It really bothers me when I get an email from people who've been trading. Maybe they've never had any education, and they say, "Oh, I blew out my whole account." So unnecessary. So unnecessary. That shows that they did not employ good money management or risk management. Also, in my courses, we go through the psychology of trading. I include a manual that has all the best stuff I've ever learned about the psychology of trading in all my years. Very important. Okay, tick charts. Yes, I use tick charts. And both are good. Time-based charts, tick charts, they have pluses and minuses. I wrote an article on that, by the way, Marty, so if you want, you can send me an email, and I'll send you that article. It's actually on my blog, but I'll send you the URL to the article about the advantages of time-based charts and disadvantages, and then advantages and disadvantages of tick charts. When I'm day trading, I primarily do use tick charts. I like them personally, but I've done both, and they're both good. Just depends what you want. Now, with candlesticks, since we're on the candlestick trading forum, actually, for candlesticks, time-based charts are better because they give better candlestick patterns. But you get good ones. You get some pretty good ones on tick charts too, and I do use candlesticks. You saw all my charts were candlesticks. Oh, okay, good one here. Yeah, this is a really good one. Thank you for mentioning this. I do not consider myself a trend trader. Okay, I know I talked a lot about trend, and thank you for bringing this up. So trend is one energy. So again, I don't depend on it. It's 1 out of 5 energies. And in fact, you know what? I don't think I even said this. In my rules, I don't have to have all 5 energies aligning. My rules say I only need 4 out of 5 energies aligning. Okay? 3 is not enough, but 4. I need a minimum of 4. And if I get 5, well, that's great. That's gravy. So, knowing that I only need 4 out of 5 energies and trend is one of them, I don't need trend. So yeah, there's a lot of trades I take that are not trend trades. They say the market only trends like 20% of the time. So if I only did trend trading, I wouldn't be trading very often. So no, I have momentum trades, and I have all different types of different trades. So when there's no trend, I can still find trades, absolutely. All right. All right. You know what? I think it's getting pretty late here. Our friends here at Candlestick Trading Forum. I've been keeping you guys late, so I better turn it off here. So, okay, yeah, the scanning formula, this is the last question I'll ask. That's part of my course, one of my courses. So I don't share those for free because it wouldn't really help you. You got to learn the methodology before the scanning does any good for you anyway. But yeah, thanks for asking. Okay, well, thank you very, very much to Candlestick Trading Forum, to Stephen, to Becky, to Jim, to everybody. You guys are great. Thank you so much for inviting me to be part of this today. Really appreciate it. Love what you guys are doing. Love your philosophy and your mission. I am totally aligned with it. You guys do a great job. Thank you for everybody who came in. And we had a huge crowd today, and I really appreciate you guys being here and taking your time. Nothing more precious than time. So that means a lot to me. And you were so interactive, and I appreciate that too. It makes it fun for me. And I actually feel bad now that I don't have more time to spend and answer all your questions because you guys are obviously very, very serious traders. So enjoy the rest of your, well, we got people from all over the world. I was going to say enjoy the rest of your night. I'm in California, but wherever you are in the world, enjoy the rest of your morning, afternoon, or evening. And I hope to be working with some of you guys real soon. So thanks, everybody.